All right. Hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our weekly options recap. I normally like to do these on a Friday afternoon. Unfortunately, I was not able to get on and join you guys live. So I did want to get a video out here over the weekend highlighting some of the trades that we closed out last week, and then also talk through a couple of trades that have our eye for next week. We have a very interesting market going into next week, so I want to walk you through a couple of markets that are jumping out at me as far as my research goes as I dive in over the weekend. If you are able to join us live, feel free to ask questions in real time. More than willing to get to those as they come in. If you are watching the recording on Facebook or YouTube or even our blog, feel free to post a comment there or email me directly, mike@netpicks.com, and I will certainly get back with you right away. So let me just make sure that my audio is going through okay. Looks like it is. All right, so let's start out with a daily chart of SPY. Let me make the chart bigger. Get my webcam off the screen. Try to make that as big as I can there. Okay. I like to start out with this daily chart. As I've talked through in the past, I'm not looking for entry signals here. I'm not looking for trade ideas here. What I am looking at the daily chart for is for overall context, big picture. I'm trying to determine, do I want to be more aggressive or conservative? Do I want to use more weekly options or monthly options? Do I want to use more long calls, long puts, or more vertical spreads? I don't want to base that decision off of what financial media is saying or what a newsletter is saying. I want to base it off of price action here on the charts. So SPY is a good gauge of the market, big picture. If we take a look at this daily chart, it has been a phenomenal move. Again, it seems like I say that all the time, but the last week we have seen another push up to the all-time highs, and we basically closed right up at the highs Friday afternoon. Now, what's interesting about last week is Sunday night. If we go back to last Sunday evening when the futures market opened, we saw some pretty decent selling. It looked like it was going to be a roller coaster of a week where we were going to get some volatility to return. We were going to get some decent selling pressure. Well, if we go back to Monday's low, first thing Monday morning, that was the low of the week. And we basically spent the rest of the week plowing our way higher with hardly any pause at all. All right, we went from a low last Friday, we went from a low of 368.22 all the way up to a high just yesterday at 388.47. That is a huge move for a big index. We are now right back into overbought territory. I do have some concerns going into next week, which I'll talk about next. But this type of magnitude on the upside, it's hard to ignore, but you have to respect it. And here's what I'm talking about. Now is a very difficult time to chase. I know everybody wants to be bullish here because the market just continues to go higher every day, every week. But you've got a lot of overbought conditions, and you've got a market that is very extended with some warning signals showing. If you take a look at the volume, all of last week, the volume for most of the week was contracting. We went from that move to the downside where we were seeing over 100 million shares trade on SPY to last week. It was a struggle all week just to hit 50 million shares. There was half the amount of volume on the upside last week compared to the downside 2 weeks ago. Now, in fairness, that's very typical. You know, when you start to see moves this extended on the upside, you will see lower volume and you'll see bigger volume on the downside. But we're hitting another extreme here where the boat is completely loaded. Everybody that wants to be bullish is already in. I think it's going to be difficult for this market to find another round of buyers here. Now, on the flip side, it's hard to get bearish because every dip has been bought, and we continue to see that. So now we're left in this limbo here, where you don't really want to initiate new long trades. You don't want to get ultra aggressive on the downside. So you're left, what do we do? A couple things that we're going to take action on next week. First of all, we're going to find some of those individual markets that are giving us opportunity. But I'm also going to take a look for a fair number of credit spreads, because selling credit spreads here, it allows us to put time decay in our favor. It allows us to get multiple ways of making money on these trades. It's just a safer way to be active in an extended market. Some key technical levels to watch. If we're going to get aggressive next week, here's what I would like to see happen. The all-time high at 388.47, clearly that is our first line on the upside area of resistance that we'll be watching. Above that level, we've got 389, 390. Those are going to be areas on the upside that we would look for potential reversal points. On the downside, if we get this thing to pull back, the very first area that I need to see broken on a closing basis is the 8-period exponential moving average. It's that solid pink line. Currently, it's sitting around 382.20. We need to see that level broken at a very minimum. If we can't break that level, if we find support there, look for just another push right back up to the highs. Below the 8 EMA, you've got the 20-period moving averages, both the simple and the exponential. Those are the green lines down closer to 380. Those are going to be areas that I'm going to watch very closely if we do start to get some selling next week. Very important to break those on a closing basis. Just probing below those levels intraday is not enough. We need to see those levels broken in a convincing fashion. I also want to see that volume spike up closer to 100 million shares. In order for that to happen, we will need to see some selling next week. Now, I talked about this last week a couple of times. For those of you that joined us on Wednesday, I talked about the ATR, or the average true range. It's starting to roll over here. It's rolling back over, and we're threatening to break the 5 handle. When we start to see range contracts like that, it makes it more difficult because you don't have as much back and forth to move, a movement to work with. It shrinks down our playbook. I want to see that start to roll back to the upside. I want to see us get back up closer to 6. Again, in order for that to happen, we will need to see some selling. If we continue to see this market head higher, you're going to continue to see the range contract, and it just limits what you can do as a trader. It limits how aggressive you can be. So I'm not going to fall into the perma bear camp. I don't need the market to crash, but I do want to see two-way movement. I do not want to see the continued one-way move to the upside without ever pulling back. Now, a couple of trades that we closed out on Friday. I want to talk through those here a moment. We've been talking in these recap videos a lot about our overnight pop trades, and I've talked about how good they have been to us over the last number of months. Unfortunately, last week, we ended the week with 2 losing trades, which I'm going to pull up here in just a moment. So with our overnight pop trades, we had a pretty decent week overall last week. With our overnight pop trade service, we closed out of 2 winners and we had a loss. For those of you that joined us on Wednesday, I talked about the winners to start the week, and then we wrapped up the week with a losing trade. So here's what it looked like. And let me go ahead and pull it up so we can take a look. So let's go ahead and open up the February 5th options. So what we did on this one is we sold the 384, 386 call spread. All that means is I'm selling the 384 call and I bought the 386 call to make it a risk-defined trade. Did both of those options at the same time. We opened this trade Thursday afternoon. We're looking to put these trades on the afternoon before expiration, looking to take advantage of the extreme time decay and the active gamma that can happen going into expiration. So ideally, what I was looking for was for price to stay below 384. That's how I was going to make money on the spread. I didn't need a huge move lower. I just needed price below 384. Clearly, we can see what happened on Friday. Market was super strong yet again. So what we ended up doing, instead of closing this one out for a profit, we closed it out Friday afternoon. And we closed this one out. Get my fill price here so I can give you the correct price. I got filled at $1.50. I closed it out for $1.50. It left us with a $96 loss per spread. The neat part about these trades, they are fully risk defined. I was dead wrong on this trade. We were looking for a pullback. We got anything but Friday. So I was dead wrong, and we only lost $96 per spread. Now, it's never fun to take a loss. Don't get me wrong. I'm not celebrating that loss, but it's nice to know that when I do take a loss, it's not going to be that loss that wipes out an account. It's just a losing trade. And when I take a look at my overall results for the week last week, we are still positive. We still made money. We had 2 winners. We had a loss. We're still making money. So the key point to make here is over time with any system, with any market, you're going to have winners, losers, and break-evens. That's part of trading. There's a lot of people promoting trade results right now, and a lot of people just saying, hey, look at me. I made 500%, 400%. They never talk about a losing trade. If you're in this market, if you're in any market for any length of time, you're going to have losing trades. The key is to try to manage those as carefully as possible. Try to limit the damage when they happen. So going into next week, we'll just pick it right back up. We don't look at this and say, hey, we had a losing trade. Let's throw it out. Let's not take an overnight pop trade again, because we know we've closed out of 13 winners out of the last 15 trades. We know the results are going to be very good for us. So unfortunately, we ended up taking the loss on the trade, and then we just pick it back up. We'll take a look for our next overnight pop trade early next week. The other one that we took was still on SPY, but with this one, this was part of our ETF service, and we used an iron condor. Now, again, I talk about this all the time. People get intimidated by the terminology when they hear iron condor. They immediately think, oh my gosh, it's overly complex. There's a lot of risk. It's actually one of the safest trades you can use. And here's how it worked. We came in Thursday afternoon and we sold the 387, 389 call spread. And at the same time, we sold the 382, 380 put spread. So all I'm doing is selling a call spread and selling a put spread at the same time. The goal there is to try to box in the price. We're expecting price to stay in between the strike prices of the options that we sold. So I needed SPY to stay between 387 and 382. That was my profit window. Unfortunately, price did not stay inside of that window. We saw the rally for most of the day Friday, and we ended up closing out of the trade for a loss. We sold the spread for 52 cents. Okay, so we collected 52 cents Thursday afternoon to put the trade on. It took up $148 of my capital per spread to put the trade on. Well, we gave it a chance. We tried to hold as long as we could on Friday, but we ended up closing it out Friday afternoon. We ended up taking a $30 loss per spread. Okay, so we closed it out for 82 cents. We bought the spread back for 82 cents, leaving us with a 30-cent loss or a $30 loss per spread. Again, SPY did not do what I wanted it to do. I was expecting either choppy conditions Friday or even a pullback to the downside. Well, we just got done talking about how we wrapped up the week with a very strong session. I was dead wrong. We ended up taking a $30 loss. So again, you don't have to, you don't have to worry about, you take a losing trade. Oh my gosh, the system doesn't work anymore. It's not the case at all. It's just a losing trade. We move on to the next trade next week. These trades have been very, very good to us over the past couple of months. So we continue to look for the next trade here going into next week. So we had a winner and a loser on our iron condors last week, and we ended up making money. So the winner was larger than the loser, which is really nice. So we still ended up, even with the losing trades on Friday, with both the overnight pop trade service and with the ETF service, still made money on those overnight trades. So really nice situation to see. And we'll pick it back up here next week. Now let's talk through a couple of trades that are on my radar for next week. I already mentioned on that daily chart that the market's very, very overbought. We want to pick and choose our spots carefully. This is not the time to get aggressive in either direction, in my opinion. If you're going to be bullish here, I'm perfectly fine with that. If you've already got bullish trades on, that's fine. I would continue to manage those trades accordingly. I would just be very cautious with any type of new long trade that you put on. If you can, cut back on position size. If you can, use a vertical spread. It's going to be very, very difficult for the market to maintain this pace to the upside, in my opinion. On the downside, again, until price action confirms, I'm not looking to come in. I've talked to too many people over the past week or two that are just blindly coming in and saying, hey, this market can't potentially, it can't possibly head higher. So I'm just going to come in and blindly buy long puts. The problem there is price has not confirmed. Price can stay overbought longer than anybody expects. If you want to lean bearish here, I'm not opposed to that, but pick and choose your spots carefully. Pick and choose your markets carefully, and then also lean towards using a credit spread here, selling out of the money call spread. It allows you to reduce the risk. It allows you to be more conservative. And if price action does decide to roll over next week, if price action does confirm to the downside, we will shift our focus very, very quickly over to long puts. All right, so let's take a look briefly at the index products. These are the charts that I actually base my trading decisions off of. This is the 195-minute chart. It will give you 2 candles a day one that closes midday and one that closes right at the end of the day. So it just speeds it up. If you look at the daily chart, it tends to be a little bit slow for my taste. The 195 minute just speeds it up. And what we're looking at here is an impressive uptrend. And this is what I'm talking about. Look at the far right edge of the chart. We're at the very top of the chart, right? About to go off the charts here on the upside. The system is already in a long trade. I don't have a problem if you've got bullish positions on because the market continues to head higher. You can just continue to manage those trades accordingly. But going into Monday morning, would I look at this chart and say, oh my gosh, this is a great buying opportunity. Let's go ahead and initiate some new bullish trades on SPY next week. I personally don't look at that chart that way. So in this case, I am personally just holding off on initiating any new trades here on SPY, just kind of in a holding pattern. At the very least, I would love to see price action come back down and break the 8-period EMA. That's that red and blue line there. The white and yellow line is the 50-period EMA. So I want to see a move down below 385 if we're going to get anything going on the downside. IWM, the Russell 2000 ETF. Very similar pattern. It's been off the charts. I mean, it's just been phenomenal what we've seen in the small caps. Very, very overbought after basically 5 days in a row of buying pressure last week. We are now left with a very overbought condition. Again, the system is in a long trade. Let me get my data box up and I'll show you that entry point. The entry point was at 211.95. Price action closed the week up above 220. This is not an area that you want to chase. If you're already bullish, if you're already in a long trade, that's one thing. Continue to hold on to that position until price action confirms on the downside, confirms that it's ready to head lower. If we're going to look for a new short position, at the very least, I want to see price action break below our 8 EMA, which as of Friday afternoon was sitting at 217.27. So nothing to do there on IWM either. I'm going to hold off, wait to see if we can get some selling pressure early next week. Qqq, the Nasdaq ETF. Very similar chart pattern across the board on all of the index products. They were very strong last week. All of them. We've seen a lot of rotation between the index products over the last couple of months. Last week was pretty broad-based. Pretty broad-based across all the index products on the upside. So Qqq is also in a long trade. If you're not already in the bullish positions, I would hold off. Wait for price action to confirm below the 8 EMA, which as of Friday afternoon was sitting at 328.78. We're just about through earnings season. Almost all of the big headliners have released their earnings, which is great. That does take some of the overnight risk off the table. We still have, of course, the COVID risk and the headline risk with the stimulus plan and so forth. But most of the big tech names, most of the financial names, the energy names, a lot of the big market moving stocks have released their quarterly earnings over the last couple of weeks. So we don't really have to worry about that any longer, which is nice, at least for the next couple of months. Now, the trades that really caught my eye as I'm getting ready for next week, doing some research. Let's talk through PayPal. This is symbol PYPL. It did have earnings last week, and the initial reaction after earnings was, no surprise, a wave to the upside. And we closed the week right up near the highs around 270. Now down below, we've got our red and yellow histograms, what we call our pulse indicator. That indicator plotted yellow at the end of the week. What that means is price has now printed between a 1 and a 2 standard deviation move on the upside. It does not mean price can't head higher from here. It just means it's not statistically probable. When you start to see yellow bars on the pulse, it will typically lead to either a period of consolidation or even a reversal in the other direction. If we just take a look at this 195-minute chart, just go back over the past few months on PayPal. If we go back to December, we got this yellow bar on the pulse indicator. What happened soon thereafter? It's not going to always happen immediately. It might take a couple of days, but look what happened soon thereafter. We saw price on the upside hit an overbought condition, started to roll over. We didn't get a huge move to the downside. We did get a slight pullback. We did see some chop kick in before the next wave higher. Fast forward to late January. We got a series of yellow bars on the downside, indicating an oversold extreme. And if we go back up to the top, look what happened soon thereafter. Almost within a day of hitting that oversold extreme, yellow bars on the pulse, look what happened to price. We started to chop sideways for a few days, and then lo and behold, we saw that pretty impressive wave to the upside. So it's a very predictable indicator for areas of exhaustion. So now when we take a look at current conditions, we're seeing another set of yellow bars on the upside. We're hitting another overbought extreme. Does not mean that price can't head higher here. It just means it's not statistically probable. In all likelihood, we will probably start to see a period of consolidation or a reversal in the other direction. We've already started to see that Thursday into Friday. We have found some resistance right around 270. Now, we really haven't rolled over yet to the downside, but we don't really need to. At the very minimum, I need to see some consolidation. Here's how I plan on taking this. When I start to see yellow bars on the pulse, for me, that's an indicator for a credit spread opportunity. I don't want to come in and buy long puts here on PayPal. It's too aggressive. Price hasn't confirmed lower. In order for me to be interested on the downside, at the very least, I would want to see the 8 EMA broken. We haven't hit that yet. Why am I willing to sell a call spread? Because using a credit spread puts the time decay in your favor. Options lose value every single day that passes. By selling a credit spread, we put that time decay in our favor. So here's what we're looking at. Let's jump back over to Thinkorswim and switch this symbol from SPY to PayPal. So now we've got a decision to make. Do I want to use the weekly options or do I want to use the monthly options? Well, a couple things that I want to keep in mind. Number one, we've got to pay attention to liquidity. I mentioned on SPY, it's been a struggle to hit 50 million shares traded on a daily basis last week. Even though we're trading the options, that volume on SPY is a very good indicator of liquidity market-wide. I want to be very cautious to make sure that there's enough volume and open interest in the options for me to be able to get in and out of trades quickly and at good pricing. Okay, very, very important. So what we looked at here to end the week is we went out to the March 5th weeklies. I wanted to go out into the March monthlies with 41 days left. Here's the issue that I ran into. When I went out into March, the ideal time frame was there. 41 days was really perfect. But when we take a look at the out-of-the-money call options, look at the strike prices that are available. There's $10 wide strikes. It was a little wide for my taste. Okay, I want those tighter strikes. I want dollar-wide strikes, $2.50 wide strikes. Even $5 wide strikes would have been okay to work with. When you start to get into $10 wide strikes, those are more difficult trades to structure. So I went away from the March monthlies and I went to the March 5th weekly options, the ones with 27 days left. My sweet spot is in most cases to look for between 20 and 40 days left to expiration. That's the ideal range that I want to look at. These March 5th options meet that criteria. We still have 27 days left, right? So we are going to go to look at the out of the money calls. And we were looking at the 275. We're looking at the 275 calls. Actually, let's take it a step further. Let's go out to the 280 calls. Okay, I'm going to right click on the 280 calls. Let's go to sell and let's go to vertical. Now, why did I go to the 280 calls? What drew my attention to those options? One of the columns that I have on my trade page is the probability out of the money column. It's this one right here. What I'm looking at when I initiate a credit spread, ideally, I want to be selling an option that has around a 65% chance of closing out of the money. So 2/3 of the time, that option is going to close out of the money. That's what I'm looking for. As of Friday afternoon, that 280 call had a 64.7% chance of closing out of the money. So I right-clicked on that one, went to sell and went to vertical, and it pops up by default a $5 wide spread down at the bottom where I'm selling the 280 call and I'm buying the 285 call at the same time. Okay, it's a fully risk-defined trade. If I get filled, it was trading for $1.87 mid-price as of the close Friday afternoon. Let's say we get filled right there come Monday morning. If I get filled at $1.87, I am collecting $187 per spread. That's my maximum profit potential. My maximum risk is $313. That number there, the $313, is calculated by taking the $5 difference between the strikes minus the $1.87 that I would be collecting to put the trade on. So I'm risking, in most cases with a credit spread, I'm risking between 2 and 3 to make 1. We're actually slightly better than that range on this trade here. You look at that saying, okay, over the next 27 days, I've got $187 of profit potential. It's not a game changer, right? It's not a home run trade, but Maybe it is, because look at the amount of capital required to put this trade on. You're only talking about $313 per spread. That's all that's going to be tied up in your account, and that's the most you can lose on the trade. If I come in and take a look at buying an in-the-money put option on PayPal to try to be bearish, if I go to take a look at the 275 put, you're talking about $1,600 per contract just to buy one long put option. By selling the call spread, it is still a bearish position. I still ideally want PayPal to move lower, but now I reduce my cost from $1,600 to $313. Much more reasonable, right? That on its own is attractive to me. If I can reduce my cost on the trade, that's super attractive. But it gets even better. If I buy that long put, the only way I make money is if PayPal moves lower, and it does so quickly. If it's not a big enough move, or if it takes too long, we're in trouble. With the credit spread, we have 5 ways of making money. My break-even point is at 281.87. You can see it right in my order confirmation box. That number there is calculated by taking the $1.87 credit that I'm collecting to put the trade on, and we're adding that to the 280 call that I sold, the 280 call strike price of the call that I sold. That's where I get my break-even. I don't care if PayPal moves up, down, or sideways. Does not matter to me as long as price stays below 281.87 over the next 27 days. The price of PayPal at the close Friday afternoon was at 269.84. I'm sorry, 269.44. Right? You take a look at that, and that's a pretty nice little cushion, right? We've got about a $12 cushion where we can be dead wrong and PayPal could continue to move higher and we can still make money. The only move that hurts me is a big move above 281.87. We're not expecting that because remember, we looked at that chart and price is already at that overbought extreme. So all 3 directional moves are okay, up, down, or sideways, as long as price stays below 281.87. If it does move lower, we're going to be able to make money faster. If it just kind of drifts sideways, or maybe we just drift in either direction, we can still make money there. It's just going to take more time. We would just need the time decay to add up in our favor. So we also make money from the time decay adding up and from volatility decreasing. So those are the 5 ways that we have of making money on the position. A lot to like about this trade. So what's the downside? Why not use credit spreads all the time? Well, I use them a lot in my own personal trading. I use them a lot with our trading students, but you are giving up your home run profit potential. The long put that would take $1,600 to buy is going to give you a bigger profit. If we do get the bottom to fall out of PayPal, let's say the market does fall apart a bit over the next couple of weeks, that long put would give you a bigger profit potential. It just comes with way more risk. The credit spread, let's just say PayPal completely falls apart and we see a move all the way down to 200 over the next 3 weeks. Not expecting it, but let's just say for our example here that it does. The most you're going to make on the credit spread is $187 per spread. So when you're right, and the market does make a big directional move in your favor, the trade-off here is the credit spread has a defined profit potential. Okay, it's a fair trade-off in a lot of cases. The credit spreads are really powerful trades to use. How do we manage the trade? The only way that I can book the entire $187 of profit is if I hold all the way up to expiration, if I hold for the next 27 days. That's not something I want to do. Ideally, what I want to do is close out of the trade when I can book between 50 and 75% of my max profit. Why would I do that? Because it would give me a lion's share of the profit potential, and it would allow me to close out of the trade without having to go through the stressful last week before expiration when options become very, very active. I'd rather book the profit before things get too crazy and free up the capital for the next round of trades. So if I can buy that spread back for between 46 and 93 cents, they seem like random numbers. Where did I pull those from? If I can buy the spread back for between 46 and 93 cents, that would allow me to keep between 50 and 75% of the max profit. All I'm doing is just taking the $1.87 there that I collected. That's my max profit. And I'm taking between 50 and 75% of that to give me my target range. So that's how I would plan on managing it. What I would do on this trade, you take it Monday, I'd create that closing order right away. As soon as that position is on, create that closing order for 46 cents. That way, over the next couple of weeks, the closing order is working for us. If it gets filled there, great. We can always adjust it. If we don't end up hitting that full target level, we can always adjust the order accordingly. I just like to have that closing order working for the target. So it's a neutral to bearish position on PayPal. I just see so many traders right now getting sucked in because of GameStop and AMC and people that are just blindly coming in and buying calls and puts. Guys, it's fun. Don't get me wrong. I will buy calls and puts, and we'll talk about a long call potential trade here in just a second going into next week. But you don't want to fall in love with one strategy. You want to mix it up. The long calls and long puts, a lot of times people, that's all they ever trade. Just remember, that's the most aggressive trade you can take. It has the most risk. It does have the most profit potential. Not opposed to using those. Just make sure you've got some other strategies to go to. So when you do get into a market like this, it's completely one directional right now. We're very, very extreme. The credit spreads just give us more flexibility to reduce the risk. Still stay very active. Still give ourselves a nice profit potential, but in a much safer way. All right. Let's go back over to the charts. And I mentioned a long call position that we were looking at for next week. We actually talked about this initially on Wednesday, but I'm going to talk about it again because the potential is still there going into next week. This is SLV. This is the silver ETF. The metals have been very active for a couple of reasons. Number one, we've got the Fed and we've got central banks worldwide just throwing gobs of money at this market, right? I mean, we're talking about another $1.9 trillion stimulus plan being announced here in the US. At some point, right, they just continue to print all this money out of thin air. At some point, we're going to see inflation skyrocket. My opinion, right? And the market's going to do what it wants. But I do think we're going to have some very active markets to deal with in gold, symbol GLD, and silver, symbol SLV. Silver also was in the headlines because there was rumors that the Reddit traders were going to move from trading GameStop and AMC to trying to make a run on silver. On that news, early last week, we saw a pretty significant gap higher back on Monday last week. It did not last long. Within 24 hours, we had seen the price come all the way back down, right? We're all the way back down to where it was trading before the headlines hit. We saw a price test the moving averages. It tested the 8 EMA and the 50 EMA, and we found some support Thursday mid-morning into afternoon. We found some support right on top of the 50-period exponential moving average, that yellow line right here. Price action bounced higher. Our trend strength histogram down at the bottom also flipped from red to blue, and that's what gave us this new long setup that is printing as of Friday afternoon. Those blue plus signs there indicate a long setup printing with an entry point at 25.24. If that level hits early next week, that would indicate a long call option opportunity. So here's how I would play it. The nice part about SLV is it's very reasonably priced. A lot of stocks that we're looking at right now, Tesla, Apple, Amazon, you take a look at the options and their price, even PayPal, you're talking about $1,600 just to buy a slightly in the money option. I mean, it's crazy right now. So SLV being a $25 product, the options are much more reasonable if you're taking a look at just buying an outright call. Well, if we take a look at the call options on the left-hand side, we're going to go out to the March monthlies, the ones with 41 days left to expiration. Normally, when I'm buying a call or a put, again, the 20 to 40-day window is my sweet spot. If I can go a little bit closer to that 40-day number, that's ideal. The farther out in time that we go, we're going to pay more for those options, but in doing so, going out that far, we're able to limit the impact of the time decay. So the 25 calls, if we hit that entry point early next week, the 25 calls are going to be the at-the-money calls. I would like to get slightly in the money. I would like to take a look at either the 24.5 or the 24 call. I actually like the 24 calls. Okay, they have great liquidity, great volume, great open interest. You're going a couple strikes in the money, and you're still talking about only $190 per contract. It's a very aggressive bullish position. The only way I would make money on this trade is if SLV moves to the upside, and it does so relatively quickly. So we've got to keep that in mind. I'm fine with that because it matches my outlook. Price action is starting to confirm on the upside. Haven't hit the entry point yet. I have to wait for 25, 24 to be hit first. But if it does hit, I'm more than willing to jump into a long bullish position. Now, let's say that we do, just for our example here, we have to wait for that entry point to hit next week. But let's just say it does hit and we end up getting in for $2. We end up buying the 24 calls for $2 or $200 per contract. How would I manage that trade? My initial target would be 100% return. I'm looking to double my money. So I'm looking to sell that call option for $4 anytime over the next 40 days if price moves higher. And then on the downside, I would use a 50% stop initially. So my stop would be at $1. So I'd be risking $100 per contract on this position. That's how I'd manage the trade on SLV. So I definitely, let me go back over to the 195-minute chart. I definitely want to be active on SLV and GLD. The gold ETF is another very active market. I believe it's both of those are going to be very active in the months to come. Am I going to be bullish indefinitely? No. I'm definitely open to positions in both directions. I will trade the metals on and off. I definitely think over the next 3 to 6 months at least, you're going to want to have at least one of these markets on your watch list. If SLV works better for you because it's a lower price product, great. We just walked through a long call position there and showed how reasonable the price was. GLD, the gold ETF, very active as well. It's just more expensive. Now you're talking about $170 ETF. So the options are going to be pricier. So, and we'll pick up gold. I do think early next week, when we come back in for our Wednesday update next week, gold is most likely going to be one of the names on our list that we look to get a position on. So it's another one going into next week. Benjamin asking, what do I think of Ford? Well, I can certainly pull up the chart, which I'm doing right now. It's not a market that I typically trade. Any of the automakers, really the only one that I trade personally is Tesla. So here's my issue with Ford and GM for that matter, Toyota. If you pull them up, here's a chart of Ford. Let me get my data box out of the way so we can take a look at more data. If we go back in time, let me just scroll back. Take a look of this stretch between late October, early November, all the way up into the middle of January. We saw a lot of choppiness right there around $8, between $8.50 and $9. I mean, price was just kind of stuck sideways right there, right? You're absolutely right that going back into early mid-January, we have seen a nice move higher on Ford. It's gone from down around 8.5 up to 12. That's a significant move for an automaker. So now price action's overbought. Ford's already made its move. Here's the point that I was trying to make. Ford is not a name that's going to be consistently active. It's a name that will have some headlines hit, it'll have some news hit, it'll be active, and it'll make a nice move for a couple weeks, and then it just sits and it chops. So if it's a long-term investment, you're looking to put on a position on Ford and hold it for the next couple of months, potentially even the next couple of years, that's one thing. If you're looking at it as a trading vehicle where you're looking to be in and out in a couple of days, maybe a couple of weeks, it's not my favorite name. I much prefer to trade a name like Tesla because there's more back and forth movement. I am not a fundamental trader. Okay, I'm not somebody that's going to come in and take a look at, a product line, or I don't take a look at the balance sheet. I don't really dive into earnings that much because I believe that everything we need to know is going to be reflected in price action on the chart. So if I take a look at Ford just from a trading perspective, not a name that I would trade. If you're looking at it as a long-term investment, that's fine. But everything I talked about earlier on the index products holds true here, meaning we've already had a heck of a move from around 8.5 up to 12. If you're already in a bullish position on Ford, I have no problem with you holding it, right? And just trying to ride the wave until we see price action give it up on the downside. If you're not already in a trade, in my opinion, odds do not favor initiating a new long trade here. I would rather wait for a pullback first. I would rather wait for price action to get back in and test the 50 EMA down around 10.5. Let it pull back. Let it work off some of this extreme move to the upside that we've seen going back into January. Let things reset before you chase. That's how I would handle it personally if I was trading it. And Benjamin, hopefully that makes sense. I know it doesn't give you, an exact trading plan on Ford, but I just don't trade it. For an active trader like myself, it just doesn't really meet my criteria of what I'm looking to do. What do I think of MGNI? It's another one that I don't typically trade. So let me pull up. Let's just take a look at how liquid the markets are. It's been pretty active. Got some pretty decent liquidity in the options. And if we take a look at the 195-minute chart, I mean, this is another one that has just absolutely exploded. I mean, if we go back into late last year, into December, I mean, we went from around 10 all the way up to over 50. Guys, we're seeing these types of extreme moves like GameStop, AMC, now this Magnite that just came up in the chat. These types of extreme moves, these are historic moves. These are not moves that are typical, and this is not going to be the new norm. This is another one where if you're already in a bullish position, don't have a problem if you wanted to hold it because you're playing from a position of strength because you've got a lot of profit here. But you take a look, I mean, this is a move over the past couple of months. What is the stock up 500%? How much more does it have left in the tank here? You have to consider, if you've already got some bullish positions on, if it were me, I would consider taking some profit off, maybe keeping part of your position on just in case it does have some additional juice left on the upside. Taking some profit, letting part of that position run. Would I initiate a new long trade here? Not a chance. It's extended, guys. 500% on the upside over the last couple of months. I mean, that's stuff that you see on a penny stock. You don't see that on a $50 stock all that often, right? So if you're looking for a new bullish position, I would wait first. Wait for price action to pull back. Wait for it to potentially test the 8 EMA or the 50 EMA first. And here's the danger. Because you take a look at this chart and you say, what could go wrong? I mean, it just continues to head higher every single day. But take a look at GME. This is GameStop. If we scroll back, let me zoom in. I'm going to zoom in and let's scroll back here. Okay, we saw the extreme move higher. You're looking at that chart, you're saying, okay, what could go wrong? I heard people that were jumping in saying GameStop's going to 1,000. There's no stopping it. You fast forward a week and we went from over $450 a share down to 50 in the blink of an eye, right? So I am not saying that you can't trade GME from the long side. You can't trade MGNI from the long side. You certainly can, but just keep in mind, these moves are extreme and they can correct in a hurry. Don't chase. When you've got profit, start to peel some off along the way. Book that profit while you have it, because things, when you start to get this extreme, it's when it turns. Right now, everybody is bullish pretty much across the board market wide. There is a very small exit. If we start to see price action pull back, I could certainly see a stretch there where we see a massive run towards the exits, and that exit's not very big. There's going to be a lot of people that are saying, get me out. This exit on the upside here, I mean, with GameStop, all of a sudden you saw that mass run to a very small exit and it intensified quickly, right? So I'm not saying we need to trade off of panic right now because we're not seeing any type of signal that the market is going to make a big move lower. But no one saw it coming on GameStop, right? I mean, I can't tell you how many people were just talking about GameStop just continuing to head higher just a week ago. Look how quickly things change. So you just want to make smart decisions. You want to make smart money management decisions, and don't chase the herd. Like, don't get caught up in the hype, because we know in the end, whether it be a week from now, a month from now, a year from now, markets will always normalize. They always have, they always will. MGNI fundamentals are completely different, though, compared to GME. Fundamental doesn't matter. It doesn't matter because price action will reflect that. So if we go to MGNI, you take a look at this chart here. And again, I'm not saying that the stock can't head higher long term. All I am saying is, based on price action, over the last 2 months, we've seen the stock go from $10 up to 50. It's up fivefold. I don't care how good the fundamentals are. That is extreme, right? So if it were me, and let's just say you put on a position down around 20. You're long from 20 and it's up above 50. It doesn't matter how much you like the stock. It's probably a prudent thing to do here. Book some profit. right? I mean, you take a look, and I give this example a lot with our students. Tesla. Elon Musk, I love the guy. He's a genius, right? And I like their cars. Don't own one, but I like their cars. Their stock is absolutely ridiculously valued. If I take a look at Tesla stock, again, I love everything about the company. I love the founder. I love the owner. This type of move to the upside, we're going back to even November. It went from 400 to 900. It's ridiculous. Love the stock. You just can't justify the valuation. So regardless of what you think the fundamentals are going to do, you have to also take into account what price action has done. And with these types of stocks this elevated, again, not saying you market out of your position Monday morning, take some profit on part of your position. Start to peel some off along the way, because again, things can change in a hurry. So hopefully that makes sense. I think a big issue that we're seeing right now, and I've talked about this over and over. I had this conversation about 10 times with people last week. The problem that we're seeing with this market is with some of these extreme moves, it's lulling the people to sleep. And the level of complacency in this market is near an all-time high. Okay, people just don't think the market can head lower. And they think that, these types of extreme moves are the new norm. It's not. We're just in a historic environment right now. This is not going to be the new norm. Tesla moving from 400 to 900 in a matter of 2 months. MGNI up fivefold in a couple of months. Those moves are not sustainable, regardless of how much you like the company. So, for Tesla, for me, even though I love the company, I'm absolutely looking to play it to the downside here in the near future. So hopefully that makes sense. I'm more focused on technicals and money management rather than fundamentals and so forth. And then also, because I'm an active trader, I do like to trade stocks and ETFs that have a track record of good movement back and forth. A name like Ford, for example. I don't like to trade stocks that will make a big move and then just sit for months at a time. I would rather trade stocks that are active on a regular basis, that have good track records of movement, good liquidity. Apple, Facebook, Tesla, Netflix. I want to be where the action is at. So that's just my preferred route to go. It's very, very different than the Robinhood crowd. A lot of times people are just looking for the next hot name on the list. I'd rather go with the names that have a longer track record. All right, guys. So if you have any other symbols you'd like me to take a look at, have you any questions on anything I've covered here today, feel free to type those in. I will be back next week on Wednesday for our midweek update. We'll take a look at silver. We'll take a look at PayPal, those trades that we talked about here today. And then we'll also take a look at anything new that is developing to start the week next week. So I'm going to wrap it up here for the day. Enjoy the rest of your weekend, everybody. Thanks for joining us on Saturday. And we'll talk to you guys here all next week on Wednesday.